Hi and welcome back to Cheeky Crypto. My name is Nick, and today guys we're going to be jumping down into the charts to take a look at Bitcoin. This time not necessarily to look at what's been going on most recently, but to take a look at previous bear market lows and how those structures formed. As I get into this video, if you find it useful and informative, hit the like button. I really do appreciate that. If you happen to be new to the channel, then why not go ahead and subscribe, tap the bell, select all notifications, and in doing so you will be kept up to date with absolutely everything that we do here at Cheeky Crypto. And if you have not yet joined us in Discord, links in the description down below. It's a fantastic community talking crypto 24/7. It's completely free, and I don't think you're going to be disappointed by what you find on down there. Okay, so before we jump into kind of bear market structures and all that, I just want to kind of walk through this really boring sideways trading activity that has been going on so far, and what might actually happen next here for BTC. So essentially, I still have my targets, right? We have the kind of double top scenario. This is still 31,460. And of course, we have our target of 33,500, although that's getting less and less likely to actually come in before we pull on down towards those lows that we've been talking about. Now, yesterday we saw this pullback down. And what's really interesting about this pullback down is we have 1, 2, 3, 4, 5 waves. Okay, so we have a 5-wave move down, which means we are probably more than likely going to see here another 5 waves come down lower. This is then leading me to believe that all of this sideways trade that we've been in for a while is actually just our B wave. Okay, as frustrating as that is, it does mean that we still haven't even progressed out of this area into a C wave just yet. So we're going to keep an eye on these things. I think here we have our 5-wave structure coming on up as well. So we have a zigzag pattern being repeated a couple of times here. I'll draw this in. I think probably best to draw it here is 1, 2, 3, 4, and then 5, like so. So basically we had 5, 3, 5, and then we have 5. We're looking for 3 waves up, and then we're looking for 5 more waves down. So that's kind of what's going on here. I haven't really got an estimate yet on how low that's likely to go, but do expect it to be, in that kind of range, maybe of $27,000, $26,000, something like that. Okay. But let's actually move on to the main subject matter, which of course is going to be taking a look at our daily chart here. And this daily chart is really taking a look at the bear market low points. Okay, and what we're going to do is we're going to take a good look at the 2013 bear market lows. We're going to take a good look at the 2018 lows, and obviously what's going on now as well. So as we kind of come down here, this is our 2015 bear market low, right? And what we want to do is we just want to understand this structure of how this kind of worked. Now, obviously, for our current kind of scenario, we hit $65,000. We went down to 28. They went up to 67. Then we went down a little bit, then to 69, and then we crashed down harder. But obviously, we haven't. We have just gone down lower than the previous lows that we were at previously, right? So, under this structure here, you can see that it is still very corrective, right? What this is not doing is giving us a trend to the downside. It is basically just very, very corrective. So, in essence, we can go A wave here, B wave here, C wave here, right? And you can see how that C wave also has our subwave counting. Now, we could articulate this in multiple different ways. So you could say it's a 5, 3, 5 structure, and I think that would be technically correct. So you'd go A, B, C here, and each of those A, B, Cs in themselves would have 1, 2, 3, 4, and 5, 3 wave up, and then an additional 1, 2, and I think it's going to be about here, 3, 4 overextended, 5 down. Okay, so you end up with this kind of pattern, and you kind of see how these corrections play out, right? And you can drill down into these lower subwave counts. Obviously, depending on what time frame you're on, you can continue these and just continue and continue and continue. But essentially, we are looking at this much larger correction, right? And it's actually technically a WXY, WXY. I mean, it does come down to personal preference, but I think ABCs are easier to communicate across to people across on YouTube, but essentially what you've kind of got here is this correction, right? And we had the bottom, and then we looked for some kind of surge upwards, and actually it was all kind of corrective up until this point over here in late 2015. Okay, so all of this is really just corrections, and you can see how we only really just pierced a little bit higher, and then we fell back down towards this low point. So essentially, if I were to map this up for you guys, you can kind of see that we had an A wave up, we had a B wave coming on down, and then we had a C wave coming on up here. So pretty basic, pretty boring, nothing much to really kind of talk about. It wasn't really doing overly too much. And this was pretty much from January 2015 through to the highs here of July 2015. So, you know, you have several months of actually upward direction moves, right? There's one pullback in the middle here. Other than that, you kind of got good traction to it. And then you fell down. And then you kind of got the really good structure here, right? We started to see a really good kind of impulsive trend-based structure. And then this is where things really took off, okay? So that's kind of, you know, how kind of 2015 bear market low formed. It was all corrective moves. And, you know, even after that, right, we didn't come down into the new lower lows or anything like that. It was a pretty decent run for, you know, say 7 months. But then we pulled back down, and then we got the trends to come in afterwards, okay? So all of that was looking pretty good from there. And again, we could articulate this as you know, multiple different things. We could look at this as our start point, this is our correction, and then this moving on up afterwards. But I'm not really going to be taking a look at the structure of the bull run. It was more about taking a look at the structure of this bear market and what's going on here. The main thing to note here is that it's all corrective, and you know, eventually you actually get the reversal. Now, if we were to, of course, use a fib, we can take a fib from the low point of our first wave down, transpose this over to here, and you can see we just came down to the 1.236 as a lower end, the 1-to-1 ratio. And if we actually just zoom in on this, because I think it's important that we understand, right, we came down here for no more than a couple of days, okay? So we went straight down, we closed below it, just above the 1.236 here, and then the very next day we went on up. Okay, so that's how quick it is. Once you go down to that 1-to-1 ratio, you can come down a little bit lower, but you're not going to stay down there for very, very long. But let's go ahead and take a look at the 2018 bear market structure, right? What was going on over here, and you know, what was the 1-to-1 ratio looking like then? So if we actually take a look at this, we can see here again we have a pretty clear corrective move here. We have a clear bounce, and then we pull on down. So we'd go again A, B, and C over here. Now this C wave is dragging out for a period of time, and in here you can see lots of kind of corrections. This actually looks like a double or a triple. I'm going to say it's a triple 3, but I think a double is probably a better way of articulating it. So I'll just draw that double. So for example, you have one A, B, and C, and then you have a small move up, and then again you have A, B, and actually, you know what? I can see it now. It's actually it's 1, 2, 3, 4, 5. You end with the 5. So basically what you've got here, if I actually remove that bigger play for a second, we've actually got a 3, 3, 5 right inside here. So you go 1, 2, and 3, 3, 3, 5. Okay, so you're pulling right the way down, just like that. And then of course on this side you would have the same. You'd go A, B, C, and then you'd have another 3-wave move up as well, just here. So you end up with this, actually that could be a, yeah, it's not a 5-wave move, but it could be a WXYXZ, so WXYXZ, for example, like that, and then you pull back down. I think, yeah, it's a bit messy, but essentially you kind of get the idea here. All correction, and you've ended in a 335 correction, taking us down to the bear market low point down here, and then from here you can see reversal, and actually we got a pretty good run, corrective, and then bam, we clearly hit an impulsive trigger point. So this actually happens in December of 2018. So January hits and things start to actually get some decent traction. February was a bit of a down month, January was a bit of a down month, late January, and then bam, we kind of really got this really good structure appearing here. It was kind of rinse repeat. There was a couple of pullbacks, and then we obviously continued up. Then we obviously had the pandemic pullback here. So pretty much from June 2019, we were trending down. We were not trending, we were correcting down, and this actually should have bottomed out right about here. Okay, and in doing so, we started to see some growth up, and then obviously the pandemic hit and we pulled back down. But essentially, that was actually going to be the bottom. Now, let's actually focus back in on this for a sec. If I take this point from our first wave pull back down, we actually go ahead and put this onto this double top area just over here. You can see the 1-to-1 ratio is $3,500, and we actually spent a little bit longer down here. It wasn't too long though, it was about a week just below this level, and we failed to go anywhere near that 1.236. And so essentially, you know, we spent, if I actually zoom in on this, I can see how many days that is. So if I actually just pop that there, we can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days. Okay, so pretty much just 2 weeks below that 1-to-1 ratio, and then bam, we kind of got that reversal. Okay, so really important that we understand that 1-to-1 ratio, the importance of it, and obviously everything that's kind of going on there. So I will remove these, but we understand that that is just corrective structure, and it will just a little bit beyond the 1-to-1 ratio in the same way that we were a little bit beyond it just here. But here we're only down there for 2 days, and this one we're down there for 11 days. Okay, so let's take a look at where we are. Right, so we obviously have this all-time high right here. Okay, we've pulled back down. We can see this is a very clear corrective structure. Now, if I take the measurement, I'm going to start with our 1-to-1 ratio. Okay, so we're going to go ahead and grab this. We're going to move it over just on top of our recent high, which was $48,000. Local high, however you want to kind of articulate that. You can see here that $23,000 is our 1-to-1 ratio, and pretty much the previous all-time high is our 1.236. What does this tell us? Well, if history was to kind of repeat itself in terms of how these bear market structures are working, and these corrections are more important to understand than percentage points, then essentially what you've kind of got is this A, B, C structure. It might overextend, it might not. Personally, my subwave counts are indicating to me that we're looking for 22,900, so a little bit lower than this 1-to-1 ratio, but not too much. So check out my other Bitcoin videos if you want to know a little bit more detail on that. Again, we can break this down into our subwave counts. We actually have this as a 5-wave move. So we've gone 1, 2, this is being 3, this is 4. We'll come back down just a little bit lower to finish that 5, which essentially makes the entire thing a 3, 3, 5 structure on a much bigger scale. So we have 1, or A, B, C just here as our subwave count. We then come up onto this side, A, B, C here. So it's a 3, 3, 5. We've seen that pattern before, and we've seen it over here in the 2018 bear market. Okay, and ultimately this is the entire correction coming in. It's getting completed on a like-to-like ratio, as we had done 2 times previously in the 2015 bear market and the 2018 bear market. Now, as I've said quite a few times, and people saying, you know, that I don't know what I'm talking about because I haven't been talking about this as a bear market. Again, I don't think this is historically the same level of bear market that people historically know. Okay, this would basically put us down at a 66%, right? And if we take a look at the previous cycles, well, this was an 84% move, and this one I think was an 86% move, okay, or an 87% move. So essentially, you know, from this all-time high to the bear market low, you're talking high 80% over into 2018. We were talking 84% pullback, and that was your bear market low. And now we're just talking 66%. Now, 66% is dramatically different for BTC than what we had seen previously. It's very, very significant. And this also leads people into thinking that, oh my God, we're going to crash down all the way to $10,000, you know, or less. And that kind of gets you down into these low 80s. It's possible, but I don't think it's probable. Based on all of the corrections that we're seeing here, it's very unlikely that we're going to go down significantly low without first getting this reversal move. Okay, so the reversal has to come in at these low points, mainly because we're so heavily oversold on the monthly and the weekly. And you know, by the time we actually pull down into this final 5th wave low of this 335 correction, I do anticipate our daily chart also being oversold as well. So looking at the momentum indicators, looking at the most probable areas, this is kind of what's going on. And hopefully I've articulated that well enough in this video to help you guys understand that $10,000 or you know, $12,000 is just not likely to occur. Of course, we can go deeper than all of this though. Let me just tidy this up. And I spoke about this a little while back. I think it might have been even yesterday. I think I might have brought it up. If we bring this weekly chart version of all of this up, and you can kind of see 84 and 86% pullbacks there. If I go ahead and throw on something like the simple 200 moving average here, you can see how this has also resonated incredibly well in the previous bear market lows. And this is also coinciding with our $23,000 target. Now, it is possible that we just come down ever so slightly lower and that we tap on the previous all-time high. That's possible. However, you know, I think it's also worth noting that this 200 simple moving average has played a pretty critical role of key support, and it would have to get broken in order to kind of go down into those lower levels. So I think they're incredibly unlikely to happen. They're possible, but unlikely. So again, $23,000 is also confirmed using history here and our 200 moving average, both of which I think can, you know, change, right? The 200 moving average, a simple moving average is an average. It only shows you the average price over 200 weeks. And, you know, it doesn't actually, it's not that meaningful. It's historical data, it's lagging and all that. I don't like using them, but it kind of shows and demonstrates the point outside of Elliott wave. And again, you know, history is there to be broken or to be written. So again, that can change. Now, maybe the EMA is your game. Again, same scenario. We close below the 20 EMA, and we come down, and we usually would close below the 50 EMA. Again, that would put us below $25,000, and therefore $23,000 is gain likely based on how far below we were previously. And again, we'll be looking to close below those exponential moving averages as well. So depending on what your game is, on whether you believe Elliott wave theory is a good strategy to apply, it's complex to understand, but if you can get it, fantastic. If you are thinking, well, the 200 moving averages are pretty good, or the EMAs are pretty good, you know, then you'll understand. Maybe you're just looking at the fibs. Maybe the fibs are on a 1-to-1 ratio, and you understand what that means. Is also indicating these same areas. What I'm trying to say, guys, is that we've got serious confirmation of $23,000, whereas we haven't got confirmation. We've in fact got very, very little to suggest $12,000. Okay, so I'm going to leave the video there. Hopefully this is a good video and that you can help you understand where we are in this market at the moment. We are incredibly close to the bottom, in my opinion. If you found it useful and informative, hit the like button. I really do appreciate that. If you happen to be new to the channel, then why not go ahead and subscribe, tap the bell, select all notifications, and in doing so, you will be kept up to date with absolutely everything that we do here at Cheeky Crypto. With all that said, done, and out of the way, I hope everyone has a fantastic day, and I'll catch you all in the next one.